Inflation numbers came out stronger than expected, but why hasn't gold moved up? And of course, silver as well. We'll be talking about why silver didn't react maybe the way we would have liked it to as well. Jeff Christian, managing partner of the CPM Group, joins us today to talk about these topics. Jeff, welcome back to the show.
Hello, it's good to be back.
Before we get into inflation and the markets, first let's talk about some accounting errors from the LBMA, the London silver inventory stock that has made the news this week. So the story is that they have initially reported more silver in their inventory than they actually had. So they stated initially 1.153 billion ounces. They actually had 1.143 billion ounces. So a bit of an overstatement here. I'm just going to read the statement that the LBMA sent to me because it's important to get their side of the story. The incorrect information regarding March silver stocks, which has now been amended, arose from an incorrect data submission. There is no link between this reporting error in March and the activity in the silver market at the end of January. LBMA is working to ensure such a mistake does not occur in the future. We are reviewing internal submitter controls, as well as looking at controls in place for trade reporting and other market stock reporting that can potentially be brought across to safeguard precious metal vault stock submissions. Currently, LBMA queries any submission which is off-trend, i.e. substantially higher or lower than previously submitted numbers, and asks for the submitter to reconfirm their numbers. This check is in place to avoid any miscalculations or fat finger errors arising. This process was followed during the March data submission. However, when rechecking this number prior to the submission of April silver stocks data, the submitter identified and disclosed the error, which was immediately rectified by the LBMA. So, my question to you, Jeff, is this just an innocent accounting error from what you can observe, or some investors in the silver space are speculating that perhaps they're rectifying and backtracking their numbers because of the silver squeeze movement that's ongoing?
Okay, I guess I'd make several points. The first one is that it looks like an accounting error, a mistake on the part of one of the depositories reporting to the LBMA how much metal they had at the end of March. It doesn't look like it has anything to do with attempts to squeeze the market or anything else. We've talked to the LBMA, we've talked to various other groups within the London market, we've talked to some depository managers, and it looks like it was a mistake. It's a really embarrassing one because it's a 116 million ounce mistake. But, I guess to be fair to them, these guys have only been reporting their inventory since July 2016. They're relatively new at it. They do say that they have checks and balances where they try to check this stuff, and it just failed. So I think the first point is that it's no big deal. I'll reinforce that by saying this. No one in the real silver market has batted an eye about this. I mean, they said this is a mistake, terrible mistake, embarrassing mistake, but you haven't seen any reaction in the real silver market. Not the guys on the internet, but the real silver market. Major producers, consumers, refiners, smelters, dealers, traders, banks, brokers. No one has batted an eye about it. And in fact, most of them aren't even talking about it, because it's not central to the market and it's not central to the price determination. So that tells you that it's not important. The third thing is, and I'll say this, we advise investors as to where and how to store their metal. And we have a list of depositories that we like, that we say, try these guys. And we have depositories that we don't like, that we say, no, don't use those guys. Their administration is sloppy. Their storing the metal is sloppy. Their bookkeeping is sloppy. There are depositories that we don't like because we don't think that they pay enough attention to storing the metal. And we've seen over the years all sorts of problems with depositories. I mean, one of my clients once got a box of 5,000 gold eagles from another depository. And he said, this is interesting, but I had asked for a box of 5,000 silver eagles. Some depositories are just really sloppy. I know depositories that have been built by wealthy people who were witnessing their metal being stored at depositories And they say, this is not good enough for me. It's not discreet enough. It's not organized enough. It's not secure enough. And they've gone off and built their own depositories and offer the depository services to other people. So, it's not all that surprising that it happened, but it's a big one.
Well, let me ask you this. The fact that they've amended their accounting, should we say, they changed their figures downwards, suggests that they have now less inventory than initially reported. Does this change the framework of the supply and demand balance of silver? Are we still in a surplus or a deficit? Does this turn this into a deficit according to the numbers? Does this change your outlook on silver at all? Is basically my question.
It doesn't really. First off, supply, demand, surplus, deficit, those are all current accounting issues, and inventories are capital account, if you will. So a change in the capital
account.
Explain the difference.
Can you explain the difference there?
Current accounts, supply, newly refined silver entering the market in a given period of time from mine production or secondary scrap being refined. That's supply, and that's a current account factor. And then demand is silver being taken off of the market for use in fabrication applications or making it into coins or other things. That's a current account accounting factor. Capital accounts are the stocks of silver or money or anything else that's off to the side. And stocks and inventories of metal are only important to the market supply-demand balance and to the price when they're in motion. If they're sitting there, they have really no price effect, right? So first off, this has nothing to do with surpluses or deficits, supply or demand. It's a capital thing. Second thing is what it is. It's a markdown. You still have silver stocks in London at record levels. They're just not at 1.24 million ounces. They're at 1.14 million ounces or whatever the number is. You still have record amounts of silver there. You still have, instead of having 500 million ounces of silver that's not allocated to ETFs in London bank vaults, bank and depositories, private non-bank depositories, instead of having 500 million ounces or so, you have 400 million ounces. But that is as much as they had for most of their history.
One more question and we'll move on to another topic. You mentioned that you've worked with some depositories that, in your words, are sloppy with their bookkeeping. Well, this kind of error, is it unreasonable to assume that other people are also making these types of errors and potentially overstating the amount of inventory that they have, Jeff?
No. I mean, it's possible, but it's highly improbable. Most depositories do better than this. And an error this size is unusual, and it is significant, but it's probably, you'd have to be a paranoid psychotic to think that this is the tip of the iceberg and you've really uncovered it, and I dare CPM Group to refute this evidence. That's a nonsensical approach to life.
All right, well, I won't take you up on that challenge right now. Maybe we'll follow up on that at some point in the future. Okay, Jeff, thank you for that clarification. Let's move on to the markets now. We've talked about silver a little bit. So in the past, let's talk about gold now. As you know, 4.2% CPI, headline CPI came out this week, the highest number since 2008. Why hasn't gold moved up?
Well, first off, gold had moved up in anticipation. One of the adages of the market is buy on the rumor, sell on the news. And if you go back to last week, the price of gold rose $55. True. And if you look at why it rose $55, you had Janet Yellen and you had Jerome Powell and you had other people talking about the likelihood that you would see a temporary or transitory blip up in inflation figures for a couple of reasons. One, we're coming out of the lockdown and the pandemic. Two, there's a lot of money built up and pent up. People are starting to spend it again. And three, you're measuring April inflation against April of 2020 when the world was shut down. I mean, let's be honest, oil prices were zero last April for a brief period of time in Cushing, Oklahoma. So you're measuring from a very low base and you're going forward. So I think there are a variety of reasons. And what we saw last week was Powell and Yellen explaining why this we'll see an increase in inflation, and it probably is going to be a transitory increase. And so there was buying of gold and silver, drove the prices up last week. And on the news, yes, there is this number. It's come off. It's come off for a couple of reasons. And one of them is it's something you mentioned, the headline inflation. One of the more significant factors is both with PPI today and CPI yesterday, the core inflation, ex food and energy, were higher than the headline, which includes food and energy. Food and energy are more volatile, so a lot of economists will look at the core inflation. And what we're seeing is the inflation across the board. Now, when you start drilling down, you say, what's going on? A lot of this inflation is due to supply chain interruptions. And those are the easily solved things. It's not that avocados are in short supply. It's that the trucking companies that bring avocados from Texas and California and Arizona to New York and Detroit are having problems. And so supply chain issues are easier to solve than supply problems or excessive demand problems. So everything that you see in the CPI and the PPI really reflect transitory inflation. And so therefore, I think a lot of mainstream economists in the buy side, institutional investors, on the sell side, brokers and banks, and elsewhere in the real world, we're looking at this and saying, okay, this is what we were told to expect. This is what we were expecting. And it is what it is. It's not necessarily a big issue. A year from now, you'll be measuring April 22 inflation figures against April 2021. And people will be saying, should we be worried about deflation? Because right now prices are high. A year from now, they'll probably be much more under control.
So, Jeff, you're right on the data that gold's correlation with inflation has been inconsistent at best. In fact, I've actually done the regression myself. If you take the CPI over the last 10 to 15 years and you graph it just next to the gold price, the correlation is really just near zero if you take a look at the entire time period. So why is it that people still consider gold an inflation hedge? Where did that notion come from?
Well, the notion comes from some strange belief system. I'll show you. This is the Golden Constant, which is the book on, if I put it right there, Roy Jastrom's book. And if you look at his conclusion, gold as a hedge against inflation, he quotes Andre Sharon, who was the head of research at the time at Drexel Burnham, which is gone, as saying the value of gold essentially derives from its capacity to preserve real capital and purchasing power. And then Jastrom writes, I select this particular quote because of the prestige of the organization and the position of the person, but statements of this vein can be found in great numbers. However, how can this proposition be so contrary to the statistical fact as to become widely believed and quoted? Because gold preserves capital in cataclysmic cases of inflation, but it does not do so in less severe circumstances. And to extrapolate gold's protection in singular catastrophes to its use as a strategy against the cyclical inflation is an example of faulty inductive reasoning. And if it weren't for faulty inductive reasoning, I wouldn't have a job, because so much of gold and silver is predicated on faulty inductive reasoning.
It's not so much that gold is correlated with inflation data, which actually is just trailing 12-month data. What I've noticed is that gold's correlation most closely tracks inflation expectations. So if you take the GLD, for example, and plot it next to the TIP ETF, the correlation there is around 95%, 97 depending on your time frame. That's pretty high. If you take a look at, let's say, the TIP ETF right now, year to date, it hasn't really spiked up all that much. I mean, it's climbed a little bit and then it's come back down. Actually, it's down. So even though we had very strong CPI and PPI numbers this week, it doesn't seem like the market is anticipating higher inflation. Would you agree with that statement, or do you have other thoughts of your own?
I always have thoughts of my own, but yes, I agree with that. And I think that you're seeing it with tips, you're seeing it with treasuries. Now another thought is sometimes when you see inflation rise, people say, "Oh, this is good for gold because inflation is rising and the Fed can't control it." And you hear that on the fringes right now, but the reality is, and one of the reasons why gold prices and silver prices are weaker yesterday and today, is that interest rates have been rising. And then there are any number of people who say, okay, inflation is rising, but interest rates are rising too, and that's going to put a brake on inflationary pressures. Now, if you look at the relationship, the statistical correlation between gold and inflation, US CPI, from 1970 to 2020, it's 9%. So that's a very low correlation. But the real kicker is from 2008 to 2020, the correlation is negative 5%. Gold has been negatively correlated in a very low level to inflation since the great global financial crisis, right? Inflation has been flat and it's still extremely low. But gold prices have gone from $800 at the beginning of 2008 to $2,000. So gold's not reacting to inflation. Gold's reacting to interest rates and money supply and economic problems and political issues and not inflation. And we've been saying this for more than a decade. Inflation's not the problem on a long-term basis. Deflation and deflationary pressures are the problem. And the pandemic and lockdown are exacerbating those problems on a long-term basis. And if you look at the 6 factors that we use and say, should investors be buying gold, 5 of them are flashing red, yes, buy gold. And one of them is saying, no, don't bother with gold. And that one is inflation. So we're saying there are all these other reasons why you would expect gold prices to rise over the next 3 years, and inflation's not one of them.
I just wanted to show this chart for the audience. We were talking about interest rates. So this is the 10-year. So you can see it spiked up to 1.7%. Up from the 1.55 level just a week ago. So Jeff, we talked about your outlook for gold in prior interviews. You had said that you anticipate another recession down the line in a few years, and that gold is going to climb to new all-time highs when that happens. You mentioned something just now I'd like to follow up on, which is geopolitical risk. You said gold reacts to political tensions as well. Well, when you look around the world, when you look at tensions spiking in the Middle East, when you look at potentially more saber rattling between the U.S. and China, when you look at some of these hotspots, do they concern you at all, or as Jay Powell would say, are they transitory as well?
Well, I don't think Jay Powell would say China's transitory, and I know my wife definitely doesn't say it's transitory. We were talking to various clients in China over the weekend, and I said I'm going to have to go back there soon. And she said, no, you don't. I said, yeah, I will. But the breakdown in international cooperation, the weakening of the U.S. hegemonic powers across the board, politically, militarily, financially, monetarily, all of those factors make the world a more treacherous place than it has been for most of the period since World War II. And those are factors that investors are taking into account. So you have investors in the United States buying gold in other countries. You have investors in Canada buying gold in other countries. You have investors around the world buying gold in other countries. If you look at, there's this silly myth about all the gold's moving to Asia from Europe and the United States. The reality is you have record amounts of reported gold inventories in the United States, in the UK, and in Switzerland. And you have an estimated 50 million ounces of gold, 55 million ounces of gold that's been bought by investors in China over the last 10, 12 years. But you have about 160 million ounces, 3 times as much, that's been bought and stored in Switzerland. And depositories are being built in Switzerland, the UK, the United States, around the world to hold all of this metal. And the reality is let's be honest, Swiss people aren't buying 150 million ounces of gold. A lot of that gold is being bought by other people, probably including some Chinese people who say, hey, I'm going to buy this and just keep it there.
Okay. All right. So I guess medium outlook on gold.
Well, a year from now, we think the gold price will be higher. In the next 3 to 5 months, we think that the gold price could move sideways to lower. We wouldn't be surprised to see the price, trend down and test some lower levels. The close-in support level is 1760, but we were there last Tuesday. So the possibility that the price goes down and tests 1700, 1680, even 1650, that is a possibility over the next few months. We think it's a reduced probability compared to what we thought maybe 4 months ago. But I think there is some scope for some weakening in the gold price over the next 3 months. But I think by the end of the year, we're probably back higher than where we are today. And then 2022, we're looking for higher prices. And then at some point, we're looking for another financial crisis and recession, which will probably drive gold to a record level.
Yeah. Well, I guess we're not factoring in here, I don't want to say unforeseen political risks, because we can't factor in unforeseen things. But things like, let's play out this scenario. I've been reading about the possibility of China overtaking Taiwan over the next, not too long from now. That would really test the U.S.'s resolve in protecting allies in the Asia Pacific region. Is that a scenario at all that you factored in as an investor? A war going on in the Pacific?
It's a factor that we look at. It's a factor with a very low probability in our scenarios for a variety of reasons. One is that the Chinese government does not want to militarily take over Taiwan. They want to do it on a peaceful basis. And they are flexing their muscles. They sense weakness in the United States. They've been thrilled by the deterioration of governance in the United States over the last 5 years. And they see that as an opportunity to be more of a power, a global power. And quite frankly, a lot of their disdain for the U.S. was accelerated by the way the United States government, the Treasury specifically, reacted to the global financial crisis in 2008 and 2009. And they were mightily offended at the way the U.S. government took care of its own bankers at the expense of everybody else, including the Chinese government and the Chinese people. So that was really a watershed time, not only for the Chinese, but for a lot of other countries saying, the U.S. has had too much power for too long, and they're really dumping on the world to save their own power elites. And that was, like I said, a watershed period. So I think that that's an issue. So I think that the China-Taiwan issue is an issue. It will be a political issue. There may be saber rattling. If you look at the defense, it's very funny because I saw somebody the other day, he's waving his arm, and he was saying how the China's Navy now has as many destroyers as the United States Navy is. And it's true, but if you look at it, theirs are what they call littoral destroyers. They're close to shore. Yeah. They're not particularly well suited for war at sea. The United States has ships that can go everywhere. We have like 28 aircraft carriers. They just commissioned their second one last year. So, we have all this power. They have all these jets, but Taiwan's a small island. And it's very funny because they have all these jets, and people will say, oh my God, the Chinese have so many more jets than Taiwan. But the airspace over Taiwan means that they have to be like one of these stupid movies that you see where all these bad guys line up and then they take on the good guy one at a time instead of ganging up. If China were to try to do some air battle with Taiwan, the jets would have to line up and wait their turn to fly in over Taiwan because they have too many jets for the Taiwan airspace to deal with. So you start looking at the military scenario, you look at what the Chinese have said and the way they've behaved, and you see, yeah, it's going to be a problem, but it's primarily going to be a political problem and to some extent an economic problem because that's one of the political weapons they'll use. And it's probably not going to be a militarily resolved issue.
So Jeff, before I let you go, I just want to say that we didn't have time to talk about silver, your outlook on silver today. We'll save that for another interview. And I know you wanted to talk about the Hunt. What really happened with the Hunt brothers back in the 80s? You mentioned to me offline that you knew them personally and you got their story. And so we'll talk about that at some point in the future and how that scenario, the squeeze that happened in the 80s, how that could be applied today. So I look forward to that conversation. But thank you for coming on today and sharing your thoughts on the markets. Thank you as always.
You're welcome as always. And I'll talk to you the next time we talk.